Today we're talking about how your buyers are going to end up getting a credit at the closing table. How they're basically getting some sort of money at the closing table. Now, this is going to depend on the time of year that they're closing. So let's go ahead and let's lay out a little bit of a number line here with our calendar year. So we've got January 1st and December 31st here. And what we're doing is property tax prorations. So ultimately, we've got this number line, January 1st to December 31st. The taxes are not going to be payable until November 1st, and that's the cutoff here in Florida. Or really the first day you can pay your property taxes in Florida, not really the cutoff. So if you're buying a property anytime before November 1st, this whole kind of time frame here, this is going to be where, as a buyer, you're paying the taxes at the end of the year. So November 1st comes along, and you're the one that's going to be responsible for paying the taxes as the buyer. And it's not just for the time that you lived in the property. So if you remember with property taxes, if you guys already took the course with us, if not, property taxes are a specific lien. A specific lien means a lien that stays on the property. So this home could get bought and sold 27 times or 100 times throughout this entire year, but there's only one tax bill that's calculated on January 1st that's payable on November 1st. And they don't necessarily have to be paid on November 1st. They could not be paid. They're really not even due until April of the following year. So just this past April, on April 1st, we had 2016 taxes were finally due on April 1st. But for this year of 2017, the taxes cannot be paid until November 1st. So again, what that means is if you're buying a property at any time in this time frame, you're definitely going to be stuck buying the taxes. And I would venture to say if you're buying a property during this time, I mean, unless the seller's really kind of, adamant about making sure everything is perfect and absolutely done on time and early and so on and so forth, they probably haven't paid the taxes here. So if you're buying within these last 2 months of the year, yes, taxes may be paid, but probably not, because the sellers would probably say, why would I want to pay the taxes? They're going to have to end up paying some anyways, because when a proration is done properly, everyone should end up paying their fair share. So everyone should end up paying their fair share when a proration is done properly. So let's say that we have a closing that's occurring, let's say the closing's happening today. What day do we got here? So that's our day of closing, June 14th. And what we've got here is this is the seller's portion when they own the property, and this is when the buyer owns the property. So you can see how we're splitting this up here. We've got January 1st, our beginning of the year here. We've got December 31st, the end of the year here. And our day that the property is closing, we'll say, is today of June 14th. So this time, this is where the seller's responsible for paying the taxes that's on the property. But even if the seller wanted to, they couldn't actually pay the property taxes for this portion of the year. The taxes aren't payable till November 1st, so for this entire year, the buyer's going to have to pay. So let's say our tax bill in this case here is, let's say it's $1,400 is our 2017 taxes on this property. So let's say that $5,400, and again, that's for the entire year, January 1st to December 31st. Now the seller is going to be able to, if this proration isn't done, the seller is going to be able to kind of get out of there and say, oh, have fun paying that $5,400, I'm out of here. So even though they lived in the property for half the year, if the proration isn't done at the closing table, which your closing company will probably handle this for you, but this is going to be important to know how to do these calculations to help inform your buyer of how much credit they should expect to receive at closing. So with this is going to be where the buyer's basically getting money at the closing table, because they're going to get reimbursed for this time the seller owned the property. And now, when you're taking an exam question for this, in the real world, the way this typically works is June 14th, because you do want to count this day of June 14th and figure out who owes the taxes for June 14th. Typically, this is going to be the buyer, although this could vary based on what it states in the contract. But typically, it would be the buyer's day. And so what that means is the buyer starts on June 14th. So for the seller, what we want is everything from January 1st until June 13th. So January 1st up until yesterday of June 13th, that would be our seller's days where the seller lived in the property. And then everything from June 14th to December 31st, this would be our buyer's days where the buyer lived in the property. Okay, get rid of this November 1st here just to keep this simple here. So ultimately, when we're trying to find out this proration, what we're going to do is we're going to take this total rate. And there's 3 different types of prorations you're going to need to know to pass your exam in Florida. You might not be asked about all 3, but I'd probably put money on it that you're going to be asked about one of these types of prorations here. But ultimately, they all work out the same way. You're taking this total amount, you're finding a daily rate, you're finding out basically for property taxes how much every single day of the year cost in property taxes. And the way to do that, we're going to use what's called the 365-day method. The 365-day method, also known as the actual days method, is looking at the actual number of days in a year, which is, unless it's a leap year, it's only going to be 365 days. So we're going to take this $5,400, and we're going to divide this out by 365. And what we're doing here is we're finding out how much every single day is worth in terms of property taxes. So how much we're racking up every day of property taxes, although these are already figured out on January 1st by the tax assessor. But to do the proration, we need to know how much every day is worth. So we take the total tax bill, $5,400, we divide it by 365, and what this number gives you here is 14.79452205 a day. So that's basically what's called our daily rate of property taxes. And now this number you usually want to figure out second to finding out the number of days, because basically this is how much every single day cost. And what we need to do is figure out how many days are contained from January 1st to up until the day of closing, so January 1st to June 13th. So you need to figure out how many days we have in leading up to this. And to calculate this out, it's going to seem tedious, and it is a little tedious here. But ultimately, what we need to do is take January, which January has 31 days. February, 28 days, unless we're a leap year, which we're not this year. March, we have 31 days. April, we have 30 days. And now with June, we're only counting the first 13 days. We're counting from June 1st to June 13th because remember, we said the day of closing, June 14th, is the buyer's day. So the buyer's responsible for paying this almost $15 for the property taxes of June 14th. So we're only counting 13 days in June. And you might be wondering, John, how are you able to rattle off the number of days in every month like that, like it's nothing? I could never remember something like that. Well, you can. You absolutely can remember something like this. The repetition alone of just doing this, and that's how I'm able to rattle this off without doing anything too crazy here. But that's not the first way how I originally learned the number of days, or how I originally remembered the number of days in every single month. There's 2 different methods that I tell people when they're trying to remember how many days are in every single month. The first one is less preferable for me, but again, the repetition with this here, I know this is like the back of my hand now as well, and that's this rhyme. It's 30 days have September, April, June, November. It rolls right off the tongue. 30 days have September, April, June, November. So those are our months with 30 days. 30 days have September, April, June, and that's really the only ones we accounted for here. Oh, and we left out May looking at that. So yeah, maybe I should have used this rhyme here, or this other trick that I prefer, because we completely forgot about May. Definitely don't want to do that. So May, we've got 31 days there. Now this is the method. This is foolproof. This will make sure you don't make a mistake like I just did there and forget about May, because what you're going to do here is take your knuckles. I don't like that rhyme because I always feel like I'm forgetting months with the rhyme. 30 days have September, April, June, November. You say that a million times, you're going to remember it. But for me, I'm more of a tactile. I like to kind of like touch and feel things. That's how I know. That's why I like real estate. You can touch and feel it. So with this, you want to take your knuckles. You got your 4 knuckles here, your spaces between the knuckles, which should be 3. And what you're going to do basically, let's see if we can see that there, kind of get at a good angle with this. You're going to start on either side. It doesn't really matter what side you start from here. And you're going to go January. So these knuckles are going to represent 31 days, and the spaces between your knuckles are going to represent 30 days, or in February's case, 28. So we've got 31 for January, February, March, April, May, June, July. And what we did there was January is 31. February, you just got to remember that's 28. That's the weird one. March, we're back on a knuckle, so that's 31. April, we're between a knuckle, so that's 30. May, and you can see how you're going through this year. You could just easily recite off the number of months. You won't forget May like I just did right there. So May, we got 31 days. June, we've got 30 days. Then when you get over here to your pinky, you've got 31 days with August. Now, the key thing to remember with this, July and August are going to be back-to-back. So when we go from June, July, so we've got January, February, March, April, May, June, July. Now, before you go in the other direction, you're going to start again hitting the same pinky. So July, August, back-to-back 31 days, September, October, November, December. So again, that looks like January, February, March, April, May, June, July, August, September, October, November, December. And if you do that, and that's, if I were actually taking the test, I'd be a little bit more careful with this to make sure I don't forget a month like that or get any of these calculations wrong, because this, overall, this isn't that complicated to do a proration. And if it does seem a little complicated now, trust me, with the repetition, it's going to start to clear away some of the mud. You'll start to see this, and it'll make a little bit more sense with you. But once you have that down, where you're very likely to make a mistake is right here with the number of months, either messing up the 30 or 31, or even just adding this in your calculator. These are simple computations, because all we're going to be doing basically is just taking the 31, the 28, the 31, the 30, 31, and 13, and adding these all together. And when we do that, we'll end up with our calculation for the number of seller days. We'll have figured out how many seller days it is that we're calculating out for here. So when we put this in our calculator, we've got 31. And you want to be careful, because like I said, this is where you're likely to make a mistake, just because it's simple computations and you're likely to go through this really quickly and leave out a number or something like that. So we're going to go through this slowly and carefully. 31 plus 28 plus 31 plus 30 plus 31 plus 13, and we get 164 days. And now I would definitely advise even double checking that number, because I've seen so many people make a mistake and they know this whole process inside and out. I've made mistakes with this, knowing this process inside and out with calculating these number of days here, and it's just a simple calculation that can result in user error. But double check that you end up with 164 days for the seller days. This is how long the seller owned the property for. So out of 365 days, the seller owned the property for 164 days. Now, this is where it behooves you to figure out the number of days first and foremost, because if you've already got this figured out and then you've got this 14.794525 per day, you could just go in your calculator and hit multiplied by 164. And you don't have to type in this long number again, or again worry about another user human error. But ultimately what we're doing, so this is our daily rate. That's how many days we're dealing with here. We're going to multiply that by 164. And then we're going to have our answer here. So 164 times 14.794525. And we get 2,000. Our buyer would get a credit. The seller would be paying or debited $2,426.30, and that would be money the buyer's receiving. Now, the way this money is supposed to be used theoretically is for the buyer when they have to pay the taxes in November, because they're going to have to pay the full $5,400, but at closing they receive this $2,426.30. But the way this is going to work out, this is just going to eliminate the cash they actually have to come to closing with. It's going to offset that by $2,426.30. So they will have some expenses at the closing. They're not paying for their commission for the buyer's agent typically. That's typically already paid for and negotiated out by the seller's listing agent. But they will have some closing costs, and this is going to help them offset those closing costs there. And this could even end up where they actually end up getting a check at closing for excess money, maybe if they made some sort of significant earnest money deposit or something like that. So we're going to talk some more about these prorations here. We're going to show another method that you might like a little bit better. This is the way maybe I'd go about solving one of these as well. We're going to do that right after this short commercial break, so stick with us. If you guys have questions, send them in on the comments. We'll be watching them on Facebook and YouTube here. Don't go anywhere. You're watching Ask the Instructor. Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Do you wish you could make your own schedule? A career in real estate allows for unimaginable schedule flexibility. Whether you're just looking to make some extra cash in your spare time or become the next top real estate agent, a career in real estate allows you to call the shots. Find out more about a career in real estate at tampaschool.com.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at Tampa School.
Hey, if you like the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm Jon Carissimo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm Jon Carissimo, and this show is brought to you by the Tampa School of Real Estate. If you're interested in starting a real estate career or maybe enhancing your real estate career, make sure you check out tampaschool.com. That's tampaschool.com, or give us a call at 813-928-0106. We've got representatives standing by to help you start your real estate career, enhance your real estate career, or maybe we've got some extra special tools to help push you over the edge to get you passing your state exam. But anyways, what we're talking about today is property tax prorations, and this is very important to understand. And in the real world, will you have to do this computation? Let's ask the question, are you required to do this computation? No, you're not required to do this computation. This is usually done by the lender, the title company, somebody else in the transaction. But it's good, number one, to know how to do this math so you can double check that to make sure your client isn't getting cheated out of anything. Because if you can find where there was a clerical error with this, I mean, you could already see here going through this how there's so much margin of error, so many chances where you could actually make some sort of mistake solving this out here. So it's good for you to kind of fact check and double check this stuff, but it's also good to help your buyer understand the closing process, to let them know. And if you've already got something pre-negotiated with the seller, which that's if you're going in the MLS, everything's all pre-negotiated for you as a buyer's agent representing the buyer. That's all pre-negotiated out of what commission it is you're going to receive, and that's paid for by the seller. Yes, ultimately it's the buyer's money that's paying the seller, who's then paying you, but it's ultimately coming from the seller, from what they're able to walk away with. They have to pay the commission and the entire commission on the property. So you could tell your clients that, hey, look, as a buyer's agent, you don't owe me a penny. I'm completely paid for by the seller, and you guys aren't paying for me whatsoever. And that's a big misconception, that there's a lot of buyers out there, especially not even just first-time home buyers, especially first-time home buyers, but even people that have transacted before. Then maybe they just don't remember the process, or maybe they did have a time where they did actually have to pay the commission, or maybe they remember when they sold their house they had to pay the commission, which, yes, they would. But as a buyer's agent, you're paid for by the seller. So your client isn't having to pay for your services typically. So it's good to inform them of that, but they will have some closing costs for if they're taking out a loan. They'll have some taxes on taking out that loan. They might have some document preparation fees and so on and so forth. If you work with a title company, it's good to kind of talk with the title company to get an idea about that stuff. But for figuring out these property tax prorations here, yes, there's some calculators online you can do, but it's just such an easy calculation here that I definitely recommend you understand how to do this. And you'll definitely need to know how to do this if you're trying to pass your state exam. So we talked about how to do this, this basic way of figuring out the number of days we've got here, which that added up to 164 days for the seller's time the seller owned the property. Our day of closing was June 14th. We're not figuring out anything with the buyer side, because what we're ultimately figuring here on the buyer side, or what this number would be what's left over out of this $5,400. So the seller's responsible for $2,426. The buyer is responsible for the rest. But all we're trying to figure out here basically is what would be recorded on the closing statement, or basically what would actually go towards their closing cost at closing. And so Logan was actually sent in a question here. So you're saying the buyer gets money for buying the house? Essentially, yes, they do get money for buying the house. Sometimes this might offset the other cost. If we have excessive property taxes on the property, this could actually end up where they actually end up with some sort of check. Maybe they're doing a VA loan that doesn't require a down payment for the loan. Most types of loans, as long as they're under a certain amount, $417,000 is that number, but I digress. So maybe they have a low down payment loan or no down payment type of loan. They could very well actually get paid for buying a house. So these are huge benefits that you want to know, but you want to go tell somebody they're going to get paid for buying a house when they're not going to get paid for buying a house. So that's why you need to know how to do this math and run these numbers here. And chances are when you run these by and your buyer sees what you're doing, they're going to see, wow, that this person is worth it for, even though they're not paying them ultimately, it's the seller's paying for them. They're like, wow, this person, my realtor, my sales associate, my agent is an essential part of this process. I had no idea how to do this types of math. Most agents don't know how to do this type of math. So this will really kind of wow your clients when you could show them that you could do these kind of calculations. You'll look like Rain Man to them when you're able to figure out all these things. But now, and Jeffrey Miller also, thanks for commenting in. Great show. Thank you. Thank you for tuning in. Thank you for watching. And thank you to everyone for liking, sharing, and subscribing if you're watching on YouTube. We do these shows every Wednesday at 12 noon Eastern Time, completely free of charge. Last time I checked, it's free to use YouTube. It still is free to use YouTube at this current point in time. But anyways, let's get into actually solving this another method. So the method that we just used here, this is typically how this is taught in the course. But there's something that really stuck with me that I learned early on with math that could apply with this as well, and that's proportions. So with a proportion, basically, this is where you're almost kind of like lining up the two fractions. It's where you have the two fractions here and you're solving for x. And what our x basically is in this case here would be our taxes. So we've got our total tax bill of $5,400. And we're trying to figure out what, and that's for the entire 365 days. And what we're trying to figure out here is 164 days. And so this little proportion thing, you might remember kind of the whole cross multiplying. You multiply across and divide by the 365 here. So if we do that, we should end up with our same number here. So let's go ahead and test our theory we have. So we've got 164 times 5,400 divided by 365. And we've got $2,426.30, which if memory serves me correctly, that should be a 30 cents, which if my memory serves me correctly, that's the exact same answer we just came up with. So there's multiple methods to solve these problems here. Whichever one you want to use, more power to you. If I remember correctly, I think this is how I solved these back when I first got my sales associate license, solving this because proportions just work so universally. They're so nice and easy to work with when you understand the process. So proportion will absolutely work as well. So let's do another property tax proration. And ultimately, so let's put this a little bit more in the perspective of how you might see this on an exam question. Because I'm sure there's a lot of you guys out there that are trying to get your Florida real estate license and you're studying for your exam. And these prorations, especially a property tax proration, not only is this highly likely you're going to encounter in the real world because this should be done on every single property transfer occurring, regardless of when it's closing or whatever, or if the taxes have or have not been paid, we're always doing a proration like this. So very common in the real world, also very common to show up on your exam. And with the exam, you'll have math questions that it's not just numbers. It's not just telling you do this, do that, and do this. It's a word problem. It's a word-based problem, which can make it a little bit more complicated, or it could also help you out if you kind of can avoid some of these traps that they might booby trap these questions with. But ultimately, what I recommend to do is once you've read through the question, the first thing you want to do is identify what you're looking for in the question, which in this case here, we're looking for a property tax proration. So once you've read through the question and you see that it's asking for a property tax proration, now I could say, okay, what information do I now need to pull out of this question here to figure out what the proration is going to be? So first we're going to need our day of closing. So you got to find in the question what the day of closing is. And then also, who pays for that day of closing? Very important to know. Not that big of a difference in the real world, because going back to that last example, we're only talking about a difference of about $15, but that's absolutely the difference between a right and wrong answer on your exam. So you want to know who pays for that day of closing, is for our closing day. Other information you're going to need to pull out of here is our property tax bill. So you want to look for your day of closing, when the closing is actually occurring, who's paying for that day of closing, and then what the property tax bill is. And now, this last piece of information you probably won't find in most questions, or if it does, it's just going to very subtly mention it, because in most cases, property taxes are not paid, but you want to find out, taxes paid. Are they paid? Yes or no, are the property taxes paid? Because that will make the difference in the type of math we're going to do. We're going to do another one just like the one we just did where the property taxes are already paid, but then we're going to switch gears and do one where the property taxes are not paid, because that's definitely a scenario that you want to know how to do. So we've got our day of closing. Let's say the day of closing is, October 17th. So we've got our day of closing October 17th. Who pays for the day of closing? Let's say the buyer. And in the question, it'll typically word this somehow along the lines typically of the day of closing is charged to the blank, which would be the buyer. And if it ever doesn't say, which it should always say, because this I don't think is a 100% rule of thumb, but if it does not say for any reason, I would assume it's the buyer's day, which is typically how that would actually play out in the real world as well. You also are going to need the property tax bill. Let's say in this case we've got let's say 9, some sort of number there, and then the tax is paid. The answer is no. That answer is always no for whether or not, the property taxes are paid if that day of closing is before November 1st. So anytime the day of closing is before November 1st, the property taxes in Florida at least cannot be paid yet. They can only be paid after November 1st. They become payable on November 1st. So this is automatically a no forever before November 1st, which is why a lot of questions probably won't mention that, but just in case they do. Because if this does say yes, it will have to be after November here, but that will be some different math that we're going to be doing after this break. So we've got our information here. This is the information you need to pull out, basically these 4 facts on the property. The day of closing, who pays for that closing, what the total property tax bill is, and whether or not those taxes have been paid, which we've got no taxes have not been paid. Our total tax bill is $9,700. Our buyer's paying for the day of closing, which is October 17th. And we'll throw a year on there too of 2017. Not that the year matters for this unless it's a leap year, but you won't have to memorize which years are leap year. I've never to this date heard somebody tell me that they've ever had a question involving a leap year on their exam. But just in case you do, you're really just throwing in one extra day, the 29th of January. Otherwise, you're just dealing with the 28th, so 365 versus 366. But I would say you're not going to have to worry about the leap year aspect. But if you could remember it, it probably won't hurt you. So let's again draw out this number line here to help visualize what it is that we're working with here. So we've got January 1st here. We've got December 31st here. So we've got our calendar year, January 1st to December 31st. Our day of closing is occurring on October 17th. So this doesn't have to be perfect. This is just to help you visualize this here. Not needing to be to scale whatsoever. And with this, it says who pays for that day of closing. That's why I always like to draw this day of closing as a box here, because ultimately this box could fall over here like this, but that'd be if the seller has to pay for the day. Well, the buyer's paying for the day, so this is going to be our stop. So we're going to count up to 16 days in October. We've got our seller days here. We've got January. We'll try not to forget any this time. February, March, April, May, June. Let's go this way. July, August, September, and finally October. So this is even more calculations you want to do. And like I said, this is most likely where you're going to end up with some sort of error when you're doing your computation. So be very careful to go through this slowly and surely. And then for remembering this, you could use the rhyme. So if you remember that rhyme I told you here, it's 30 days have September. So we've got September, 30 days, April, June, and November, which November isn't on here. Or you could use the knuckle method where we've got, again, your knuckles represent 31 days. Between your knuckles represent 30 days. We've got January, February, March, April, May, June, July, August, September, October, November, December. Which when we fill in the blanks here, we'll end up with 31, 28, 31, 31, because remember July and August, they're back to back with 31 days. We've got our 30 days in September down there, and now for October. We're not counting the 17th, because remember, Who pays for the day of closing? The buyer, which means this is on the buyer's days. So this counts towards the buyer's time, which we're not doing a calculation for the buyer's time. In the next question where we flip this around, that's going to be a little bit more important. But for this year, we're just trying to figure out our seller's days. So we're only counting 16 days in October because remember, this day of closing belongs to the buyer. They're charged for the day of closing. So in October, we've got 16 days it is we're going to account for here. And ultimately, once we've added these all up, and this is where you want to be careful because like I said, you're very likely to make a mistake putting this in there. Not to say that you're bad at using a calculator. I like to think I'm pretty good at using a calculator, but I've made plenty of mistakes with this here. So just be very careful putting this into your calculator. We've got 31 days for January, 28 days for February, 31 days for March, 30 days for April, 31 days for May, 30 days for June, 31 for July, 31 for August, 30 for September, and now 16 that we're counting in October. So should we end up with 289 days if I did the computations correctly, which I don't think I had any wrong numbers, but that's why I always recommend double checking this here. But we'll go with that 289 days. So the seller lived in this property for 289 days. And that's what we're going to figure our computation based off. The seller lived in there for 289 days. So what we need to do at this point is find our daily rate. So we're going to find our daily rate by taking the entire tax bill of $9,700, $9,700, and we're going to divide it by the total days in a year, which is 365. So when we take that, plug in our calculator, 9,700 divided by 365, you see how nice and easy that is there? That's where you're not likely to make a mistake. But punching in the addition sign 17 times with the exact same number, or really like 11 times that we did there, it will definitely, very likely to cause some sort of error. So our daily rate ends up being 5, which this is why you want to do this ahead of time, because you could now leave this in your calculator. Just leave that right there in your calculator, hit times 289 days. Because that's ultimately what we're trying to figure out here, the total for the seller. Every day is worth about $26 and some change, but we want to find out what the buyer is going to be credited at closing for these property taxes. So we're going to multiply that by 289, and we get a final answer of $7,680, and we'll round here to about 27 cents. So that would be our proration in this example, $7,680.27. This is how much money would the seller would have to pay. The seller would be debited. The buyer would be credited, where they're being reimbursed for this. So on their closing statement, they'll have some charges for like the down payment, if there is a down payment. They'll have charges for any sort of loan fees if there is a loan, and any other like document preparation and other things that the title company may charge, title insurance and things of that nature, depending on what's in the contract and who pays for what. But ultimately, there should be a proration. There should be this proration, and you want to make sure that your client's able to get this proration. You want to make sure you know how to calculate out this proration so you know how much your client could expect to get towards property taxes. So when they say, oh, I got to pay $20,000 down and then I have to pay another couple thousand in closing costs and title insurance and all this, but the good news is $7,680.27 will help offset that. Now, what this ultimately means is they still have to pay that $9,700. The buyer still has to pay the entire tax bill for the property. So they still got to pay that almost $10,000 come November 1st, but they're going to get $7,680.27 credited to them for the 289 days the seller lived in the property. So we're going to take another quick commercial break here, but when we come back, we're going to go into solving this when the taxes have been paid, which we're going to flip some stuff around a little bit here. So stick with us, send in your questions in the comment sections. Make sure to like, share, and subscribe. We're going to be right back after this commercial break.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Do you wish you could make your own schedule? A career in real estate allows for unimaginable schedule flexibility. Whether you're just looking to make some extra cash in your spare time or become the next top real estate agent, a career in real estate allows you to call the shots. Find out more about a career in real estate at tampaschool.com. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at Tampa School.
Hey, if you like the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm Jon Carissimo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm Jon Carissimo, and this show is brought to you by the Tampa School of Real Estate. Every Wednesday, we come into your homes, into your phones, into your devices, into your tablets, your computers, whatever it is that you're watching us on, whether it's the big screen or the small screen, to help you understand the technical side of the real estate industry, which is what we're doing today on property tax prorations. And while we're on the break, I saw a couple questions that came in, so I just want to address those real quick. So we've got, and this is a live show, so if you have questions, put them in the comments, and I'll try to give you guys a shout out on the show. So we've got a question here from Ryan Owens. This must be for agents who do not have a mortgage lender. Cash buyer show? Not necessarily. So just because the lender normally does this computation doesn't necessarily mean you want to fact check the lender and what they're doing to see if they're really actually calculating this accurately, to see if they maybe made a mistake with this here, or maybe when the buyer asks you, or maybe the sellers ask you when they see this closing statement, they're asking you as their representative. Maybe they have a better relationship with you than they do the lender, which they absolutely should. They should have a better relationship with you than they have with their lender. So they might be asking you, hey, what does this number mean? How is this calculated here? How are they coming up with this? Shouldn't it be this? And then you can kind of walk them through this right here to help reassure them, to help make you look good and establish a good reputation with this here. And now for cash buyers, this is especially important because, yeah, if there isn't a lender involved in this here, maybe you're a little bit more on your own with this here. Maybe the title company is with this, or that also kind of ties into this question that we got from Matt Fisher over on YouTube. So Matt asked the question, what about wholesale houses? So wholesale, any sort of investor or any type of situation where the seller's a little bit more savvy about this process. So, or maybe they have an agent that's trying to kind of really make it so the seller is minimizing their cost and their expenses, because the sellers already got to pay the commission. They've already got to pay some title insurance typically. They might have some other fees. And then on top of that, another $7,680 that they'd have to pay. That's definitely eating away at the money they're able to walk away with from the property. So if this is an investor, if this is a wholesaler, if this is somebody that wants to walk away with as much money as they can and they know what they're doing, because a typical seller probably wouldn't get into that much detail with this here. This is also good to know how to computate this for your sellers, to say, hey, look, you're going to have $7,680.27 eating away at your net profit for the tax proration it is. So another reason you want to do this, but this is something you want to be aware of, because if you're ever not using one of the standard contracts, or even in the standard contracts, you could kind of work this in there where the seller says, no, I'm not paying the $7,680.27. It won't say they're not paying this dollar amount. It'll say that they're not paying a proration for property taxes. And now, again, this is where your knowledge comes in for understanding how to calculate this, to tell your buyer, well, you know, the seller doesn't want to give you a kickback or proration for the property taxes. They live there almost the entire year. I mean, over 9 months out of the year, almost 10 months out of the year, they live there. And they might say, oh, no, that's all right. I mean, it's our property taxes, just a cost of ownership, right? And it is a cost of ownership, but the seller owned it for most of the year. They owned it for 289 days, which, figuring out what that number is, the $7,680.27, they might be like, whoa, that's maybe a deal breaker. This is something I want to know. And the more stuff you can know up front rather than on the back end, this is the concept which you also learn about in the course called an express versus an implied contract. An implied contract is anytime there's information that's not 100% known, whenever all the details are not fully negotiated out, versus an express contract. An express contract is where everything is fully detailed out and negotiated out ahead of time. The buyer and the seller both know the whole picture of the transaction going into the transaction. So they get a contract signed, and that has all the details and the kinks worked out. When you're upfront about everything, no one's going to feel deceived when they get to the closing table and they see that this, and maybe, who knows, maybe somebody walks away from the closing table. Now we got this person suing that person. You're getting roped into this, and now all of a sudden they're suing you because they feel like you had an obligation to tell them. Even if you didn't have a duty or an obligation to disclose this information, they could still sue you for it. So the whole point of this, to avoid that whole mess we could get into, is to understand this information up front. So if somebody does if the seller is trying to get out of paying this $7,680.27, you're upfront about that. To say, hey, look, they're not paying for this here, so you're going to have to pay this whole $9,700 at the end of the year, and they're not giving you a penny towards that. And they might be saying, well, okay, well, let's negotiate that. So that's the number of what their fair share is. So maybe you can negotiate off of that when you're going into a contract. But it's essential. If you want your contract and your transaction to go smoothly, to get as much of this stuff negotiated and ironed out to begin with. So you have what's called an express contract. If anything's up in the air, for lack of a better term, where it's undecided, that's called an implied contract, and that's going to blow up in your face, which you do not want. That makes your job much more difficult. It adds a lot more man hours and time. It's difficult to be upfront about things like this when you don't have agreement, but it's better to get agreement up front rather than to try to get agreement once an agreement's already been made. So definitely want to try to get everything negotiated and detailed out ahead of time. So let's go ahead and flip this around now. We've done this situation where the property taxes are not paid, but now let's figure this exact same scenario where the taxes are paid. So where the taxes have been paid, and the other thing that has to change in this case is this closing date, because again, in Florida, taxes get paid, they become payable on November 1st. So what we have to do here is we have to have a date after November 1st. So let's say we're closing on December 5th. We'll leave it as the day of closing belongs to the buyer. We'll keep it as the $9,700, and we'll say that, yes, the property taxes have been paid now. So this is a different scenario that we're dealing with here. This completely flips things around, and this is where your debits and your credits switch around. So rather than the seller having to pay, this is actually where the buyer is having to pay for their fair share, because what ultimately happens in this case, so we've got our tax year again. Draw out this handy dandy, and this little tax year number line, you don't always have to do this, but when you're learning this concept, this really helps out to help you visualize, especially if you're a visual learner, to understand how this is broken up. So we've got January 1st here, and we've got December 31st. And again, our day of closing was December 5th, so we're almost here at the very end of the year. And with this day of closing paid for by the buyer. So that's our line of demarcation, if you will, our split from what is the seller's days versus what is the buyer's days. And so what we're trying to figure out now, since the taxes have been paid, this means that the seller paid the entire bill of $9,700. So the seller paid for the entire year, but the seller isn't living there for the entire year. And yes, it's just a very small amount that we're dealing with here, but it's still something that, if we want to make sure everyone pays their fair share, this is going to be a very small number out of this $9,700. About 1/12 of that, 10% is $970, so it's still probably about $800, give or take some, that we'll probably end up coming up with here as our answer for this one here. So that's still a pretty decent sum of money that I wouldn't want to leave on the table. $800, even if this is a couple $100,000 transaction, $800 is $800. Get you a couple nice dinners. So let's get into actually solving this out. Enough with the why we want to solve this here. So let's first get into the number of days here. The number of days. And now this is where you want to be extremely careful. This is also like what you'll see in the rental prorations where you're calculating out the buyer days here. So we know that December has 31 days in it. So December has 31 days. Our day of closing is the 5th of December. Slash right there. So our day of closing is December 5th. So we want to count the days. Remember, we're going to include the 5th here. We're including the 5th because the day of closing is charged to the buyer. And now with this, we're trying to find the buyer days. Again, we're trying to find buyer days here because we need to reimburse the seller. The seller paid for the entire year and the seller's not living there for the entire year. So we're reimbursing the seller about $800 or so. That's just my estimation of what this is going to come up with. We'll see how close I actually am when we solve this out here. So all we're trying to do is figure out this time period to figure out what the dollar amount for the property taxes are from December 5th to December 31st. So we could say, okay, buyer, pay up, debit the buyer, credit the seller for this. And this is where it flips around because the taxes have been paid. If they haven't been paid, it's like those two examples we did before, which is typically how you'll see it's not only in the real world, but on your exam. But this is, if you know how to do it the first way, if you just know you're doing the opposite with this here, it's really not much more difficult. So we've got December 31st, or December has 31 days in it. Our day of closing is on the 5th. Now what you want to be careful with here, and if we just look at December, so December, there's 4 days here belonging to the seller. So most people would be inclined, since our day of closing is December 5th, to subtract 5 from 31. Because we're taking out 5 days, but you're not really just taking out 5 days. You're actually only taking out 4 days. December 1st, 2nd, 3rd, and 4th. So 4 days, that's going to be our seller days of December. The remaining days are the buyer days. So you're only subtracting 4 days in this case here, not 5 days. And that's a mistake that I see more than anything with this, as well as with rental prorations. We're calculating those as well, is forgetting about this day of closing. And you'll notice how I counted on my fingers there, because your fingers don't lie. Unless you put one down halfway through, they're not going to lie to you. So I know it kind of seems kind of childish to do this, but what also is not good is getting the wrong answer. So I'd rather count on my fingers than rather have the wrong answer. So it's a foolproof method. That's why they teach you that in elementary school when you're first learning this type of stuff. It works. You just count your fingers. So 1st, 2nd, 3rd, and 4th, we've only got 4 days for the seller. So what we're going to do is subtract out these 4 days from the seller. And what's that? 27 days we end up with here? You can see how much I rely on the calculator. So 31 by 4, yes, 27. Never be too sure about this, especially on your exam. So we've got 27 days out of the year is our buyer days. The buyer owned the property for 27 days. Now what we're going to do is again find that daily rate. We're going to take our 9,365 for our daily rate of 26.575 and leave that number in your calculator. That's why you want to find the number of days first, because now you can just hit it with the times. 27, and you end up with $717.53 when we do a little bit of rounding there. So I was close. I said about 800, which, given that little margin of error there, I'm not too bad. I'm pretty proud of that estimation. I am off, which is why you want to know how to do these calculations, just so you can kind of tell them, hey, look, you're going to have to pay $717 because the seller already paid the property taxes. So this is going to be another charge that you have at closing. And yes, if there's a loan, the lender should be able to calculate this out. Will you need to double check the lender? Probably not, because it's usually not them manually solving it out like this. It's usually they punch this stuff with your computer. It gives them a printout. And as long as they entered in all this information up here correctly, everything should be good. So with the lender involved, they're going to basically give you a good breakdown of all this. But when they say, well, how come I have to pay $717.53? And if you're even able to just say, hey, that's your fair share of the property taxes, they'll probably say, oh, okay. And then, but if you have somebody that's upset about having to pay that $717, because this might be where the buyer feels like they're getting nickeled and dimed on everything, and the more you can explain this, the less they see it as being your fault with this here. When you're able to clearly explain how this calculation is came up with, then they might just get overwhelmed and say, okay, I guess there's no way around this, huh? And they'll understand that it's not your fault. But if you don't know what this number is or how this numbers came up with here, you'll look like you don't know what you're doing. And if you want to get referrals, you kind of want to look like you know what you're doing. If you want to get repeat business, you want to look like you know what you're doing. And not just look like you know what you're doing, but know what you're doing. And this is simple stuff that you got to learn in the course anyways to pass your exam. And the reason why they require you to learn this in the course, this isn't us coming up with a curriculum of what you need to know. This is the Florida Real Estate Commission. They deem this important because this should be involved in every real estate transaction. And again, this is going to be super important for you to know as a professional, or even just as an investor, when you're buying wholesale properties or investment properties, or a situation where the seller's trying to really maximize their profit and what they're able to net and walk away from the property with. Because if this isn't calculated out beforehand and you just agree to the having to pay this up front or having the seller not have to pay a proration, that's where you could be losing your buyer or your seller. You could be costing them thousands of dollars if you don't know what this is or how to calculate it out. So to avoid having to call your lender every 5 minutes every time you need a calculation done, you could solve this calculation out pretty easily. Not too difficult to do, and like I said, it's definitely something you need to know for your exam to pass that. And it is involved in almost every single transaction, or at least it should be involved in every single transaction if we're gonna make sure everyone pays their fair share. So that's the property tax proration. That's one of the many things that you learn in the real estate course about real estate. So even, and I tell people this all the time, even if you don't start a career in real estate, taking this course is gonna make you a more savvy homeowner or property investor. Or when you actually go out there in the real world doing this stuff, you'll know how to calculate this stuff out. You'll know what it is. And so when your buyer asks you these questions, which you'll probably get, your buyers like to ask you questions, your sellers like to ask you questions, when you don't have an answer for them, you don't look like you know what you're doing. And that's not the look that you want to go for, because that's not good for reputations and referrals. So it's really essential that you have this information. Real estate is all about the knowledge it is that you have. The more knowledge it is that you have, and actually putting some action behind the knowledge, because it's not the knowledge alone. You do have to actually do the things that you learn, but part of that is being confident in the things you learned. If you're confident in solving this calculation, you'll have no problem going out there and actually solving this calculation out. If somebody wanted to argue with me about proration and say that I'm wrong on a proration, I could lay this all right out in front of them, and maybe if I did make some sort of error, I'll be like, okay, up there we go. Forgot about that May, forgot about calculating in May there, but I'm confident behind this stuff, so I'm not afraid to use this. So when you're confident in the knowledge, you could go out there and execute that knowledge perfectly. That's all I've got for you guys this week on this week's episode of Ask the Instructor. Make sure you guys tune in next week. If you guys haven't subscribed yet, go to youtube.com/Tampa School of Real Estate. I know it's the super longest URL username in the world. If you just go on YouTube and search for Tampa School of Real Estate, you'll see like thousands of videos from us popping up. So just go in there and subscribe, because you'll get email notifications every single time we post a video like this, because this stuff is essential not only for passing your real estate exam, but understand the industry it is that you're in and how to do these calculations and do these numbers and run these things so you become a more valuable asset. There's all kinds of stuff going on of realtors with blaming one thing or another, but ultimately it's about you becoming better than everyone. In any sort of competitive marketplace, the more it is you're able to rise to the occasion, the more knowledge you have, the more you're able to execute on the knowledge, the better you are, the better you'll be in comparison. And your buyers and sellers are going to see that, and they'll see that you're a knowledgeable professional that knows what they're doing, that they could trust with the largest purchase or the largest sale in their lives. And that's what we're here to do, to help you guys out. So if you're thinking about starting or enhancing your career in real estate, check out tampaschool.com. Give us a call at 813-928-0106 or text us, and also check out passfirsttry.com, where we've got our recommended strategy to help you pass your exams on the first try. I'm Jon Carissimo. The show is brought to you by the Tampa School of Real Estate. Tune in next week, Wednesday, 12 noon Eastern Time. Thank you guys for tuning in.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Do you wish you could make your own schedule? A career in real estate allows for unimaginable schedule flexibility. Whether you're just looking to make some extra cash in your spare time or become the next top real estate agent, a career in real estate allows you to call the shots. Find out more about a career in real estate at tampaschool.com. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at Tampa School.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm Jon Carissimo. You're watching Ask the Instructor.